Marcus is a 41-year-old electrician in Hamilton. He left his union job 2 years ago to run his own contracting business. He had a strong first year, $85,000 in revenue. He figured he'd owe roughly what he used to pay as an employee. Then his accountant handed him a tax summary showing $14,200 owing. Almost $7,400 of that was Canada Pension Plan contributions he had never budgeted for. Nobody told Marcus he would be paying both sides. Here is the rule that blindsides almost every new self-employed Canadian. When you work for an employer, CPP is split. You pay half, your employer pays the other half. That employer's share disappears quietly from each paycheck. You never see it, never feel it, never think about it. The moment you work for yourself, you are both the worker and the employer. The Canada Revenue Agency expects both shares from you, every cent, at tax time. For 2025, the self-employed CPP contribution rate is 11.9% on net self-employment earnings between the $3,500 basic exemption and the year's maximum pensionable earnings. Marcus earned $85,000 in gross revenue and had $12,000 in legitimate business expenses, vehicle costs, tools, a home office, his phone. That left $73,000 in net business income on Form T2125. His CPP bill, $73,000, minus the $3,500 basic exemption, gives $69,500 in pensionable earnings. At 11.9%, that is roughly $8,270. He can deduct the employer half, about $4,135, which brings his taxable income down to approximately $53,160 after the basic personal amount. His combined federal and Ontario income tax on that income runs about $15,100. Add back the full CPP bill, and Marcus owes roughly $23,370. He had set aside $9,000. The gap was more than $14,000. Here is the trap inside the trap. Self-employed Canadians get until June 15th to file their return. Most people hear June 15th and assume that covers everything. It does not. Any balance owing is still due April 30. Miss that date, and the CRA charges compound daily interest at its current prescribed rate starting May 1st. A $10,000 balance unpaid for 45 days, from April 30 to June 15th, costs roughly $111 in interest. A small number, but entirely avoidable. The June 15th extension is for paperwork. It is not for money. Here is what to do this week. Step 1. Open a separate savings account right now and start moving 30 to 35% of every payment you receive into it. For most self-employed Canadians earning between $50,000 and $100,000, income tax plus CPP lands squarely in that range. Step 2. Log into CRA My Account and check whether you owe installments. If you owed more than $3,000 in net tax last year, CRA may already expect quarterly payments due March 15th, June 15th, September 15th, and December 15th. Step 3. Start a mileage log today. A notebook in the glove box or a free app takes 30 seconds per trip. Vehicle expenses are one of the most valuable deductions on Form T2125, and without a log, the CRA will deny them. Step 4. If you owe a balance you cannot pay in full by April 30, call CRA at 1-800-959-8281 before the deadline. Payment arrangements exist. A proactive call puts you in a far better position than silence. April 30 is 16 days away. If you are in your first or second year of self-employment and you have not set aside 30%, the full breakdown of what you actually owe and every deduction you can use to reduce it is in the comments.